I want to thank all of you for joining today's Hispanic Heritage Foundation Investors Forum Capital Markets Charla. This charla is part of our annual Hispanic Heritage Foundation Investors Forum initiative, which is taking place in a few months, thanks to the continued support of our TIA, of our sponsor, TIA Institute. For today's charlas, we have invited a few experts in the industry to provide insights on the rich experiences of our investor community in equity markets outlook, divergent inflation expectations, COVID impact on different sectors, and how current markets should impact investors' asset allocation. Before we get started, I would like to welcome you all to be part of the conversation by sending your chats to all participants and attendees. That way everyone can join the conversation. We will have a few minutes at the end of the charla for a Q&A session. Please make sure to submit your questions in the Q&A window found at the bottom of the Zoom bar. And as many of you all experiencing during this virtual setting, kids screaming in the background. Welcome to the charla. And it is my great pleasure to welcome our moderator for today's charla, Ophelia Basgal. Thank you for joining us today, and take it away, Ophelia.
Thank you. And it's not a Zoom meeting unless someone forgot to mute themselves, there's a dog barking or children screaming, one or the other. So we'll go from there. Well, I'm delighted to join all of you today. Emmanuel and I go back, our paths originally crossed when we were both serving in the Obama administration, and we have continued to stay in contact since then. And I was asked to moderate this panel. I'm really on the customer, the client side. So I serve on the board of trustees of the Alameda County Employee Retirement Association, which is about a $9.8 billion fund. I'm also on the board of Mills College and the San Francisco Foundation, which each have endowments that are professionally managed. So I look forward to hearing from my panelists on a number of different questions. And I'm going to go kind of in alphabetical order. So I'll go to Jesus.
Hi, good afternoon. Jesus Argüelles. I'm a director of investments with the James Irvine Foundation. We are a California-based foundation that manages over $3 billion, focused on empowering low-income workers to find more family sustainable jobs. Thank you.
Thank you, Jesus. Samara?
Hi, good evening, everyone. My name is Samara Mejia Hernandez. I'm a founding partner of Chingona Ventures. We're a venture fund that invests in seed and pre-seed companies all over the United States. We've done Fund 1 and made, in 23 months, made 22 investments, so very active. We invest in fintech, future work, femtech, food, health and wellness, and ed tech. While our mandate isn't only to invest in women and minorities, we have close to 80% racially diverse CEOs and over 50% women CEOs.
Thank you. And Anthony?
Hi, everybody. I'm Anthony Valencia. I am the co-managing partner of East Los Capital. We are a lower middle market private equity firm with a strategy that revolves around tech enablement. So we look for companies that are underutilizing on the technology front and put in world-class technical advisors to help those companies. Prior to East Los Capital, I spent approximately 2 decades on the buy side, researching and investing in publicly traded equities, and about 5 years looking at venture capital, seed, and Series A level companies.
Thank you, Anthony. So just by way of backdrop, I mean, this is not going to be news to anybody, but clearly the global stock indices have really generated strong returns in 2020 and the first quarter of 21, even though the economies were slowing due to COVID. And those gains, though, were driven by a handful of large capitalization winners, really, whose businesses sort of benefited from the pandemic, while a lot of other businesses struggled. And so, and we know that the broader equity gains were resulting from a combination of the monetary response by the Fed Reserve, the rapid stimulus response, and the ability of markets to sort of look beyond the pandemic. I think there is a fair amount of optimism. So I think I'm going to start with Anthony and just ask, in light of that, where do you see the opportunities in public, private equities, fixed income? What are you thinking about going forward?
Sure. Thanks for the question. If I had my old hat on in public equities, it would be a very challenging environment because, as you alluded to, Ophelia, by almost every, traditional valuation metric, things are not cheap. And that's kind of putting it nicely. With my lower middle market private equity hat, it's a little different situation because we're obviously holding things for a longer period. We think that equity versus fixed income is still the place to be, especially in an inflationary environment. We're looking for companies that are typically much smaller than a publicly traded company, so we're catching them early in their growth phase and putting in operational improvements over 5 to 7 years. So we're looking for companies that have pricing power in the event that inflation really takes off. Companies that can be tech enabled or can tech enable other companies. We're looking at a lot of things in cloud services, which help small businesses move to the cloud, which makes them more efficient. So that's kind of where we're spending our time right now.
Okay, great, thank you. Clearly the tech sector had a very successful time during 2020 and 2021. I mean, partly because really online penetration in terms of, people working remotely, shopping remotely, all of those sorts of, changes in how we live today. I mean, we're on Zoom, right? And who knew about Zoom prior to most of this happening? Some of us used it, but not to the extent where this is how you conduct your family meetings these days. But Samara, I'm wondering from your perspective, where do you see the opportunities in tech particularly? You just said you do a lot of early venture investing. Anything in particular you'd share with us where you think the future might be going?
Yeah, it's interesting because in the second quarter of last year, everybody was worried. Many people redacted their term sheets. They stopped investing. They focused on for their portfolio companies. And I would say that lasted maybe about a month and a half, 2 months. And then you started seeing people come into market and coming quick. And then from call it June through now, it's just been a race to get money deployed. Startups are coming back out to market a lot quicker, raising rounds. Venture funds are coming back into market, raising funds. A lot of larger funds are coming into market. So there's just a lot of money coming in. That's from a high level. From a specific sectors and what we're really excited about, one of the things that we're sector agnostic, but areas we like are fintech, future of work, femtech, food, health and wellness, and edtech. And a lot of those sectors have really accelerated during COVID. So food tech is a place that accelerated the most, I think, in our portfolio. As people were at home and food delivery startups stayed. E-commerce was a big one for us. So the way we shop, changing the way we think about what we wear, how we wear it, what brands we connect with, and also just democratizing access to a lot of different things, whether it's education, whether it's financial technology, or investing even, right? So you're seeing non-traditional people come in and invest in GameStop and some other things. And so there's a lot of changes. I think, there's some that we're still trying to figure out, is this going to continue post-COVID and when we go back to normal, whatever that normal is? So some of the trends that we're seeing there, we're actively looking to invest in. And there's some trends that are evergreen. So like healthcare, for instance, democratizing access to healthcare, mental health. It got accelerated by COVID, but it's something that's going to stay. And it just brought to light areas in the market that had the biggest need. So like in communities of color in particular, right? So those are kind of areas that we're looking at, but we're also assessing what changes are going to stay and what changes are going to fade out of it.
Great. So I'm going to go to the other side now, and that is sort of the headwinds that we may be, facing. This has been, as everybody knows, a K-shaped recovery, a new part of the lexicon of which we talk about, which is really the recovery has magnified the inequities in, basically education, racial equity, employment, all those sorts of things. And, it's the feds are clearly attempting to address that with the stimulus package and also just the monetary policy. But Jesus, given the kind of underlying mission of the Irvine Foundation, what do you see in terms of, what are we going to do about these headwinds? What does it imply for investments, both maybe specifically at Irvine, but also just generally, what do you see in the market?
I think actually to build on what both Anthony and Samara said, I think it's it's a difficult environment to invest in, mainly because of valuations and this question of what does growth look like going forward. And so some of the things that Samara pointed out, for example, is activity it slowed, but didn't stop and actually accelerated in venture capital in 2020. And the other thing we saw was that for those companies that were using tech and tech enabled, it accelerated and moved up the growth curve because of COVID. So if you would have expected adoption was ramping up and would have like hit, increased levels in 2022, 23, it really accelerated 2020 and 2021. And I think people, I will give credit to my colleague on the hedge fund side who said, people throughout looking at 2020 earnings and 2020 forecasts and actually started looking at 2021 and 2022 when investing in public markets. And I think you saw a quick growth. And so what opportunities lie? I think actually technology, will continue to disrupt every facet of our lives, and some for the good and some for the not so good. And I think, but that it'll enable things like better access to educational tools, better access to healthcare, better access to food. If you think about like actually just getting higher quality food, technology will enable that. And I think there's the headwind though of people, especially in Congress and other positions of power, really testing when is a company too big to fail on the tech side and when is it limiting growth. And so I think there's going to be this natural tension. And then last thing I'll just highlight is the tension of, we all know it, we may not put a name to it, but we all know the chasing of yield is something that we've seen quite a bit of over the last probably even decade. And so I think when you see the yield curve steepening and alternatives of potentially fixed income actually returning a yield potentially, I think that's going to put pressure on valuations and equities.
There's so many variables coming together. Clearly the market was impacted by the liquidity. There's so much cash out there. And, I do want to get to GameStop and the whole sort of retail investors at some point, just about what does that look like for the future. But I am sort of curious in terms of, this is sort of asking you to look on the public policy side. I think the markets are feeling relatively optimistic about, legislation and things right at the moment, but we know that there are, progressives who want to see changes. And any of you interested in commenting on, how, if there's legislation introduced that would change, pretty significantly some of the ways markets are dealing with things right now, or going after Facebook in terms of, how they basically benefit off of our information, that being one example. Just any thoughts on the public policy side? I'll leave that to whoever'd like to take it.
I'll take a stab at that, Ophelia, because some of the big tech companies that you just mentioned, the FANG stocks, right, the Facebooks and the Googles of the world, that have been in the headlines for all the reasons that you just mentioned, they're so large that they control the indices, right? And I think Jesus made a comment about that earlier in the conversation. So, theoretically, one stock shouldn't make a difference, but I think at these inflated valuations that we have, there's so much kind of animal spirits that are pushing the markets. And the Fed has kind of put a safety net under the markets and has made a lot of people believe that they just won't let the markets go down. So at the first kind of hint of some of these big mega tech popular companies, the Facebooks and the Googles maybe taking a nosedive, it could kind of create this free fall in the markets in general, just because sentiment changes. So I think, just to your specific question, that's the way I'm looking at things.
Samara or Jesus, either one of you want to comment on that?
The only thing, I think, Anthony, your point on the concentration of a small handful of tech stocks in the S&P 500 and just relative to other indices is a really important point. I think at some point it was around, actually, I don't want to put the figure because I don't remember it exactly, but I want to say 20% of the value. And I know definitely a significant portion of the gains of 2020 were driven by, the FANG stocks in the MSCI at least. But what was I going to add? I think part of what we're seeing on this hiccup right now in terms of tech valuations is a question of taxation. I do think corporate taxation is something that is on everyone's mind. Not that will it happen, it's what will it look like? Because I think everyone expects tax changes to happen. And so I think you could see, if you see capital gains tax changes happen, if you can see income tax changes, people will, I think that could impact some parts of the public markets at least.
Samara? And if you...
Yeah, no, not too much to add. I think from a different perspective, we're looking at what opportunities that our portfolio companies have. So changes around education and access. And I have investments in ed tech. And so looking at, okay, what are these policies that are going to happen, whether it's education, healthcare, or others, how is that going to positively impact us in opening up doors and opening up budgets for our companies to sell into or to benefit from. So I'm looking at it from that perspective. It's interesting because from the public side, historically, the public side usually took any changes took 9 to 12 months to get to the private side, and now those worlds are converging a lot. They're kind of intermingled now, and we're seeing the SPACs. We're seeing a lot of public investors going in private and going in much earlier. So it makes me a little bit uncomfortable, right? Because it moves a lot quicker. But at the same time, there's still a lot of unknowns. And so I'm watching, I'm looking for opportunities, but I'm also cautious.
Yeah, I mean, I think it's interesting. I can tell you from the foundation side that, the prospect of when taxation changes and things, when we saw a lot of money flowed into the donor advised funds at the end of the year, just, I think people sort of getting ready to get their portfolios aligned properly in the event there were tax changes. So, it'll be interesting to see where that goes. We have a question from the audience, and I also want to encourage everybody to go ahead and put your questions in. This is from Mario Valverde. Thoughts on the demand for private capital, equity and credit in institutional portfolios. Jesus, I'll start with you. Response to that?
Yeah, so thank you very much for asking the question, Mario. I think the answer is demand will remain high. I think, again, the search for yield is a very important driver of this. And also the view that private equity with its long-term nature in terms of hold periods, as well as its ability to actually have strong governance change, I think it provides an alpha generating tool that isn't necessarily available to equity owners in other markets. I will say though, that when you look, and I encourage everyone to look at the Bain 2021 buyout report. They had some interesting stats in that report around dry powder. And actually, and I'll pull it up really quick, which was, if you look at the dry powder 2021 versus 2010, actually direct lending has seen a 7-fold increase in dry powder, and traditional buyouts 114% increase. And so I think there's a significant amount of capital headed into these markets, and there's quite a bit of capital on the sidelines. That doesn't mean that it won't increase. So I think demand will remain high among institutional investors.
Do either of the other panelists want to add anything to that?
Yeah, I'll just say, from a fundraising perspective, there's a lot of other sources that are coming in and wanting access to the private markets. And I would say that a lot of corporate companies, corporate VCs are looking at the private markets, I think, in a very different way and wanting access for the same reasons that we all talked about. And so from just a fund manager's perspective, I'm starting to see a lot more interest here in sources of capital that I never thought were available, which I think is great. The one thing I question is, okay, how long is that going to stay, right? Because institutional investors have done this. They kind of earmark you for fund 1, 2, or fund 2, 3, 4, and 5. And so how much of that is going to continue? But for us, at least, I think that provides a great opportunity for us to go out and obtain sources of capital from non-traditional sources.
Anthony, I don't know if you want to add anything.
I would just add that yesterday there was a Federal Reserve meeting and Chairman Powell essentially indicated that there'll be no change in the easy money course through 2023. And as long as that remains the status quo, then, whether it be, the search for yield or the search for capital appreciation, we're going to continue to see very strong demand in these asset classes.
Yeah. Thank you. And I'm so sorry, probably going to mispronounce the last name, but we have a question from Jeff. I'm hoping it's Munji, perhaps. And the question is, where does the stock market gains go when the market cools off and people pull their money? Since opportunity zone investments are an option to shelter gains, is there enough education and access to have a material spike in that direction? And I used to work for HUD, so I'll be interested to hear what people think about opportunity zones. Who'd like to take that?
I'll just say, unfortunately, I don't have a real estate background and don't know enough about them. So maybe that shows there's a need for education.
Yeah.
I hate to give the "it depends" answer, but I think part of it will depend on the interest rate environment, because a lot of the opportunity zone investments are basically real estate centric, and in a rising interest rate environment, then those might be less attractive. I think from a public market perspective, if the U.S. stock market has a major correction, investors that have a mandate that they can go outside of the U.S. will then look for other markets that are more attractive on a relative valuation perspective. And today you can compare CAPE ratios, cyclically adjusted PE ratios, and see kind of big divergences between the U.S. and some emerging or international markets. So the money will probably go to these other markets.
I would just say on the opportunity zones, and at least in some of the early reports that I've seen on the analysis of them, it's not provided the sort of access to capital as to which they were presented of. It was going to be these, local businesses and local communities. I mean, it really has been large investors. It's primarily turned into real estate. So it'll be an interesting review, I think, of where that goes over time. We have a question from Annabelle Hiron. Does the prospect of inflation in the next few years impact your investment decisions today? Anthony, I'll let you take that one and start.
Sure, absolutely. I mean, that's one of the $1 million questions on Wall Street is, are we going to see inflation or deflation, which is, maybe a separate conversation, but it's kind of fascinating that there's such a large school of thought in completely divergent directions. People thinking that we're going to have hyperinflation, and other people thinking that we're going to have deflation. I'm in the inflation camp, and so in an inflationary environment, we presume that we're looking at higher interest rates. So we look at investments based upon that. And to my comments during the introduction, we're looking at companies that have some sort of pricing power, that aren't going to be hurt on a relative basis by inflation. But at the end of the day, for what we're doing at East Los Capital, because we're a lower middle market private equity investor, is we have the 5 to 7 year time frame, and we're looking to improve companies, via technology improvement or sweat equity. So we're not being judged on a quarterly basis like a lot of public managers. So if we have a downturn, if inflation creates a recession for a couple of years, we think the opportunity for us is that our companies can gain share, and with the kind of technical talent we have, emerge on the back end stronger than ever. So that's the way that we're looking at this.
Samara, anything you want to add?
No, I would just say on the so the investments that we make, and it's the same thing that Anthony said, it's a long-term approach, right? We hold for 5 to 10 years plus. And so it's not the the changes that we see, or the different valuations aren't as quick as they are on the public side. But we also look at businesses that cater to the 99% of the population, and also that hopefully aren't as affected by changes in someone's income, or can withhold different cycles, market cycles. And so for us, yes, it's always obviously a concern, but we invest for equity. We don't use any debt with this, and it's a longer term approach. And so we're always watching it, but it's not a something that is going to affect our investment decisions on a day-to-day basis.
Okay. I mean, I think we're early in this cycle with the Fed policy. I mean, even though it seems like it's been going for a while, but whether there's inflation or not, I guess we'll see. I mean, there certainly are people who are convinced that we're going to see a rapid rise in prices as soon as these stimulus checks are out, but we'll see. A couple of quick things. In the chat, Jorge, and I tell you, I should have my glasses on, Salchis, I think it is, just offered, if anybody wants more guidance on opportunity zones, you can reach out to him and he'd be happy to provide info offline. We have a question from Ivy Flores, thank you, which says, with the rollout of the vaccine and quantitative and monetary support, it seems to point to continued growth in the economy, possibly more faster inflation than expected. What do you see as the risks in the US and global markets? And is it realistic to have approximately a 7.5% hurdle for many institutional investors going forward? Anthony, maybe that one's for you, or Jesus, either one.
I think one of the risks is that what's outlined in the question actually doesn't happen. And we don't see the growth that everybody is expecting. And then we have more of a stagflation environment where we potentially have high inflation and no growth. So I think that that's one of the risks, and that would go to the reset of valuations in the markets that we talked about earlier.
And what I was going to add, I think that's right, and it's definitely one of the key risks. But was that the 7.5% rate, assuming it's nominal, actually becomes easier to hit if you have it, because there's going to be, if there's inflation, there will be a response on the yield side, right? And credit markets will get disrupted. And I think an important also element to just highlight here, it's the expectation of inflation that matters more than just inflation itself. And so it's it being a dramatic surprise. And I think that's one of the reasons you have the Fed being very clear that they're comfortable living with inflation above the target for a period of time. And I think that's becomes really important because it allows people to plan for that kind of scenario. And the last thing I'll just add here is, I think the question of inflation is tricky when you start seeing its impact from, is it demand side driven inflation or supply side driven inflation? And to me, with I believe M2, supply went up 27% last year. We saw the fiscal balance sheets of the Fed, or the Fed's, balance sheet growing 76%. That I think points to more money supply, which then should mean more demand side driven inflation, which I think companies will be able to, manage that. It can manage that a little easier than if it was purely supply side driven.
Yeah, and I would just add on the 7.5% hurdle. So many of the pension funds that I talked to, people have been lowering their return for some time. So, a lot of people are at 7, or some folks below now. So interesting in terms of that was then. Be interesting to see what they do now in this particular market. Have a question from Roberto Peña. How are international investment opportunities being seen at the moment, given the uneven COVID recovery abroad? Particularly interested in your thoughts on emerging markets and specifically LATAM. So who'd like to take that? Anthony, you're unmuted, so I'm going to let you take it.
Our mandate is mainly North America, with the exception that, thankfully, at least for this question, we have looked and are looking at a number of companies in, again, the cloud / kind of IT services space, which are based in LATAM. Basically, they are offshore, nearshore companies. Most of them have some sort of legal domicile in the US, and the clients are US based. So we're not looking at that as a pure play LATAM investment, where we would have to consider things like currency risk, local governmental issues, even the COVID, rollout uneven that the questioner posed. But we think that there are a lot of opportunities in LATAM. The valuations are slightly less, and the technical talent is excellent. So we're spending a fair amount of time looking in LATAM, and it fits into our thesis very well.
Okay. I wanted to ask Samara a question that just more is about how you're operating in this environment. So much of venture capital is really relationship building and networking, and I often hear from our investment consultants who say it doesn't reflect the efficient market because of the way it is built on relationships. But are you finding it challenging in this environment and to network and build those relationships in the way you might have in the past?
So yeah, look, pre-COVID, I'm a fund manager here in the Midwest, but I invest all over the United States. And so I would travel every other week somewhere, San Francisco, LA, New York. And but I have made investments through video pre-COVID. So it wasn't a brand new thing for me. Initially I had to quickly figure out how to change that approach and that style and make it so that I could find, these founders all over the United States. But I've been doing this now for almost 7 years. And so I've built these relationships these core relationships all over the US. So that continued. But in terms of building the new relationships, I would say that's become a little bit more difficult. But in terms of, keeping up to date with someone, we used to see each other at events. We used to see each other at this forum, 2 years ago, we saw each other. And so it was just a great way to connect and like, oh yeah, we don't have to keep up a quarterly catch up because we're going to see each other at these events. And so that's been challenging, or just being top of mind. Also fundraising during a pandemic when it's all over videos and many institutional investors are not used to that. That's been challenging as well. But I think many, at least I would say that are more open to committing over video. And so also the fact that hopefully there's a vaccine soon, right? People are like, well, maybe we can do this over outside, having walking meetings, right? And so I don't do that with my founders or the people I just don't want. I want them to feel comfortable. But that's been that has been a challenge, but we've just repositioned it. The big thing for me is having exposure to make sure that founders do find us, that we find these attractive deals, being top of mind and being creative with that, given our size and given our resources. But I hope some of this will continue, and I think it will. And some of this, and people are now able to do Zoom all the time. But I also can't wait to see people in person, and hopefully we can all see each other next year.
Thank you for sharing that, because I think it sort of gives a little look behind the curtain of how things have changed in terms of the operational aspects of business. So appreciate that. I'm not surprised that a question has come up about SPACs. And, when I looked at the numbers, I couldn't believe that, it's like 6 times what there was, before 2019. And something like 50% of the IPOs that we've seen in the last 6 months or so have been SPACs. So we have a question that kind of goes to SPACs generally and also startups, but it's from Robert Medrano. And thank you, Robert, for the question. It's, what is the outlook for startups funded by VCs? And a separate question to the panel as to what is your opinion of the SPACs? Samara, if you wouldn't mind, if you take the outlook for startups, and then we'll go to Jesus and Anthony on the opinion about SPACs.
Yeah, so I invest so early that none of my companies have been in that position to be acquired by a SPAC. But in general, I think it's great that there's a different opportunity to go public, lowering the costs, going in earlier, not having to wait. People were staying public longer, and there's a lot of access and new players coming in and be able to run these SPACs. And so I think overall, from that perspective, again, democratizing and changing the way we think about going public is great. It's interesting, those that do go public and seeing their numbers. I've talked to a few founders that are like, wow, okay, I have better numbers than they do, and I'm still private. Should I be doing a SPAC? And so it's interesting how you're kind of opening the hood underneath some of these startups that are growing at all costs, raising a ton of money. And you're like, the business fundamentals are interesting, and that's the startup world, for better or worse. And so I think it's good overall. I'm interested to see what's going to happen with all these SPACs being raised, and they have 2 years to find a company and go public. And I'm interested to see how many of those will get acquired and what that looks like. And those running these SPACs. There was a meme, I think, somewhere today on Twitter, but like finding the people that are actually qualified to run these SPACs and choose these companies, right? Like, it's interesting to see who are being chosen for this. And so that could provide a new wave of non-traditional investors, but I'm also curious to see the analysis behind choosing these companies. So there's a lot here. I think it's really interesting, but only time will tell, I guess, how this plays out.
Great, thank you. And Anthony, I know when we talked about in some of our prep work, you said, SPACs, they've been around forever. This is not new. So, but go ahead and share your thoughts on that.
Sure. I mean, I guess I would preface it by saying that an easy money makes it possible for SPACs and those types of investments to flourish compared to when we were in an environment that was didn't have the type of easy monetary policies we have now. What you're alluding to, Ophelia, as I mentioned in a previous conversation, that back in, let's just say, the 2000s, when I was on the public market side, and there were people that were pushing SPACs, and people in my seat more or less wanted nothing to do with them because LPs didn't give us money to then invest in a blank check company where we had no idea what they were going to do with it. Things have changed. PE has been pretty active in the last 12 months on the SPAC side, and there's some advantages from the perspective of private equity companies and maybe relative ease of raising money, of having less capital committed to control a larger investment. At HHF Capital, we haven't gone down that route yet, but I think once the easy money starts to kind of subside, you'll see things like SPACs start to kind of fade out also.
And if I could just add, from an institutional investor perspective, one thing to keep in mind is the question of alignment of interest between the institutional limited partners in a private equity or venture fund and the economics related to that SPAC. And so I think GPs could be thoughtful about how they, when they go and raise, how those economics are shared with the LP base, because ultimately the time and attention of some of these firms, it raises a question around the time and attention that they're spending on the institutional product versus the SPAC. And I think time will tell. I think economics are changing because they are pretty GP friendly, and I think that's one of the reasons why many are raising them. But I do think Samara's point around the market is looking for other mechanisms of listing. Now that's a very important point that this isn't the first time, but like direct listings, for example, I think are an important mechanism that are discussed. And I think it's just showing you that the market's trying to disrupt a very established market when it comes to IPO listings. They're doing it using the same instruments, but there's this desire to disrupt and gain access to private markets also.
So speaking of disruption, let's talk about Bitcoin. So, or cryptocurrency. So I had mentioned when we had our pre-call that, we were actually having donors at the San Francisco Foundation donating cryptocurrency, which we immediately sell, at least at this point. So we missed the run up, obviously, by making that as a strategy. But Jesus, maybe we'll start with you. Just thoughts about cryptocurrency and disruption in the market with that. Where does this all fit in? in terms of investments?
Well, clearly it's become more accepted to invest as institutional investors in cryptocurrencies. You know, you hear talk, I don't remember exactly who said it or if it's lore, but that, like, you know, it's an alternative to gold. You can put 5% of your portfolio in it, and, you know, it's an alternative place to store value. And I think the market has made it easier when you think about, you know, ledgers and just the valuation and how to actually like physically own cryptocurrency. Fundamentally, I think the jury's still out, in my opinion. I should disclose, I'm not an investor in Bitcoin, so I've missed the run up. I look to my associates who are active on the cryptocurrency side, and, you know, they're more bullish than I am. But I think fundamentally it's a question of, is it truly a currency? And if it is a currency, you know, how will governments respond to that? So I can dig in more, but I think it's gaining steam and could, but there's still quite a bit of a tail risk when you think about the way governments could respond and regulate crypto.
Yeah. Samara, you were nodding in your head there. Do you have any thoughts you'd like to share?
I was just nodding. I mean, well, because so personally, yes, I have invested and bought, you know, cryptocurrency, and I'm up 178x from when I invested and all that. And so it's a personal thing, but I don't invest it through my fund. I know there are dedicated funds for that. And I'm just kind of shaking my head because, or nodding because, so I worked at Goldman almost 10 years ago, and I was on the public side, and I could spit out like what we thought about the market and our research and all that. And it's been years since I've done it. So this is nice. It's bringing me back into it. But a lot of what we talked about with our clients, our very sophisticated clients, was, you know, there's a lot of trends. There's a lot of, right now, there's the SPACs, there's the Bitcoin, there's the crypto, or there's, and you know, looking at what is going to stay, what is long lasting, what plays can we have, you know, as I would call it, sprinkles in our portfolio of alternatives, of things that are hot, right? The GameStop stocks and all this other stuff. But at its core, like, what are we looking for? And so for me, it's always businesses that are going to withstand different market cycles, that have a core business fundamentals, good unit economics, are getting to revenue, to profitability, right? I know this is like not a thing in startups, but for my companies, it's like, can you control your own destiny? If there is a downturn, if something else happens, you know, if there's pandemic number 2 or whatever it is, do you have enough to sustain you? Do you have to go out and raise? And so for me, it's nuts right now, like, you know, in terms of the amount of money, the valuations, all that. And so I'm constantly like, feel like the old Midwestern mom that's just like, nope, don't raise a ton of money, don't raise that valuation, only what you need. And it's really hard because so many people are coming at these founders, giving them term sheets, you know, giving them more money than they actually need. And so that's just the mindset that I developed at Goldman, and when I, you know, advise my clients, and that's just the way I think about it now. Of course, personally, I will do my own investments and have fun with it, not put, you know, 90% of my portfolio, of my personal portfolio, in it, but I will do that and watch it. But from my venture fund, my fund, that's not something that I will do.
Well, and I think the most amazing part to me is to think you would do an investment where you couldn't remember your password, you know, and you watch it just blow up on you. It's that. Or just recently, all this digital art and digital media, which people are buying. It's like, what is that about? You know, it's really, it does point to our earlier discussion about the amount of liquidity in the market, is people do have that kind of money to throw around. So I want to move over just because I don't want to miss having an opportunity to talk about it, because you alluded to it earlier, Samara, and that is the retail investors and the whole GameStop, and not just GameStop, but we know that Best Buy and, you know, Best Buy and Beyond, or whatever, the Bed Bath and Beyond, that's who it is, and AMC, and, you know, what are the implications of that? I mean, you know, GameStop was up significantly last Friday, still hasn't come down. So if it's a bubble, when's it going to blow up? So, you know, whoops, excuse me, Anthony, any thoughts?
I think that, you know, retail inflows are now something that really drives the market, and the ability due to social media, you know, whether it's Twitter or Reddit or, you know, what have you, to actually almost increase the hype that would normally just be more, you know, kind of person to person and whatnot. It happens in you know, it's instantaneous, right? So a group of investors that like an idea, this can get transmitted all over the world instantaneously. So you know, it can actually be responsible for you know, large market movements like we saw with GameStop. Now, you know, there were people in the whole kind of GameStop AMC, you know, Wall Street Bets scenario that you know, has said, hey, the retail cannot be driving, you know, this sort of price activity, that, you know, essentially institutional money, you know, i.e. that the bad hedge fund guys are probably infiltrating Wall Street Bets, and, you know, they're behind some of this, you know, don't sell, somewhat strong arms, you know, I think they call it diamond hands, you know, something to that effect. So, you know, I think that the takeaway is that, you know, retail is a real force right now. But again, it just keeps going to this theme that I keep kind of, you know, droning on about, which is easy money. And, you know, easy money makes it easy for money to find a place to go. But once the plug gets pulled on that, you know, all of this will kind of recede, in my opinion.
You know, a term that Samara used earlier is the democratization in so many, and a lot of people look at this as that. And, you know, kind of sticking it to the hedge funds kinds of things. And yeah, Jesus and Samara, either of you want to comment further on this?
Yeah, no, I mean, that's one of my areas, thesis of this democratizing of financial access and education. And so it's interesting. So I invested in a company called Early Bird, and they help parents create their kids' first investment accounts. Literally, when your child, the minute they can get a social security number, you can open up a bank account. And it's gifting, and it's using videos, and it's making it emotional. But the key here is teaching your kids to invest early on. And you can, you know, choose a portfolio of ETFs, but then you can also selectively choose specific stocks to add on to that, and stocks that people care about. So whether it's GameStop, whether it's, you know, whatever it is, it's helping kids teach from the beginning what investing looks like. And that is something that's been a trend and will continue to be a trend. And this, you know, GameStop was, again, in those scenarios were a little bit nuts in how it happened. But in general, I think, you know, especially for us Latinos, many Latinos that didn't grow up with access to investing. I didn't know what investing was until I got to Goldman Sachs. We, you know, just as a broader kind of perspective on the Latino community, we're now having a much higher median household income. 1 out of every 4 kids born today is Latino. We have higher education, right? Our demographic, our purchasing power is changing. And I'm not just talking about the Latinos, but in general. And so how do we teach kids? How do we teach people earlier on to make this investments and make smart investments? And so, you know, I watched a documentary the other day with GameStop, or it was GameStop, and there was a little kid where his mom bought him a GameStop stock because he liked games so much, and he bought it like a year or 2 ago, and like his stock went up really high, like very quickly, obviously, and he was able to talk about what happened in the market. In the video, he was able to talk about what going short means, and I was like, what the heck? When I was at Goldman, I was like, it took me a while to figure out like buying, selling, you know, going short, put calls. And this kid was like 9 years old talking about it. And so I'm like, that is fascinating. So for me, yes, there's these things, and it's like, you know, you can talk about a cancel culture, you could talk about like sticking it to the hedge funds, but more broadly, it's a really exciting opportunity that these kids and these non-traditional investors are having access to it and really understanding, or at least trying to understand, what investing means.
Great points. Jesus, I mean, given Irvine Foundation's sort of, you know, mission in terms of economic development stuff, what's your thoughts about, you know, education around investment, particularly in the Latino community?
Oh, it's a topic of discussion, and a significant topic around, you know, when we think about we talk quite a bit about income inequality or income disparity, but we don't talk as much about wealth inequality and wealth disparity. And I think actually that's where the conversation needs to go, is how do you actually create mechanisms for wealth creation in a more effective way? And I'll still kind of align that Anthony was saying. Maybe it's the curmudgeon in me, the old guy in me, but I would just caution in saying that the GameStop AMC phenomenon, one is considered investing. I would say be careful expecting outcomes like that, because for every, and Samara, I think it's a phenomenal story of like that boy, but there's also the other story where you hear people levered up their family's house and lost their entire life savings in GameStop and AMC. So, but the second thing I would say is there's a great book called A Short History of Financial Euphoria by Walter Galbraith Jr. And what he basically just says, and it's only 118 pages or something, but it just sums up how there's periods of booms and busts in history. And this is just, I think, an example of other booms and busts. But I do think the idea of democratization of the financial markets is so powerful. Robinhood, so powerful. You think about what is happening in terms of like the ability to actually use your money to have a loud voice is very powerful. And so I think this idea of the Latino community coming up is this is a trend that's been happening, and I think will continue. And I think there's, I think it's an opportunity for the community to go, where do I want my voice to be heard? I would say not necessarily in driving up a GameStop or AMC, but there's other ways of doing it, right? Just being more active and really thinking of conscious capitalism.
Yeah, I really appreciate that insight. I'm just going to share a personal story. My brother, who was a lawyer, but we had in our family knew nothing about investing. And when my parents passed away, these people worked hard their whole life and acquired properties. And, when I distributed the cash, it was a reasonable sum. And he said to me, well, I've invested in the stock market. And I said, oh, well, what'd you buy, mutual funds or whatever? He bought one stock, BlackBerry. And not at the time when you wanted to buy BlackBerry. It was like a stake through the heart. I couldn't believe it. And, so anything we can do to educate people around that, I think will make a huge difference, to your point, Jesus, about wealth building. We are approaching pretty much the end of our time here, but I want to just make sure if there's any other questions from the audience that anyone wants to raise, now would be a good time to do that. And let me just thank the panelists, I think, for a terrific conversation and for answering the questions so well. So give a minute here and see if we have any other questions from anybody. And looks like not. So let me turn it over to Emmanuel, who I think wanted to make some closing comments.
Yeah, thank you all for attending, the audience members for submitting questions, and everyone on the panel, Jesus, Ophelia, Anthony, Samara, you all have rich experiences, and not just from your current organizations, but historically, everything you've done in your careers, and we appreciate you bringing them to the table. I invite anyone in the audience to submit ideas for other topics that we should tackle. Collectively in our community, the Hispanic Heritage Foundation community, we have an amazing knowledge base and experience set that we can essentially educate each other. And that's kind of part of the theme here, that we don't need to go outside, we have it here. So let's continue kind of driving it forward and making sure that we drive an impact in the institutional investor community. With that, thank you all, and looking forward to seeing you at the next program.